Welcome to CoreLogic RP Data's update on housing market conditions for December 2014, proudly brought to you by Credit Union SA. Over the month of November, capital city home values fell by 0.3%, down in most capital cities. Over the last 12 months, home values have increased by 8.5%. That's still a strong rate of capital growth. However, on an annual basis, that's the lowest annual growth in 12 months. Over the 3 months to November, capital city dwelling values were 0.8% higher, and over the past year, capital city values are 8.5% higher. Home values have shifted higher over the year across each capital city, with Sydney leading the way with values increasing by 13.2%. Melbourne has been the second strongest performing capital city, with home values 8.3% higher over the year, followed by Brisbane with an increase of 6% and Hobart where values increased by 5.2%. Perth and Darwin have recorded the lowest increases in dwelling values at just 1.4%, followed by a 1.7% rise in Canberra and a 2.8% rise in Adelaide. Despite the monthly fall in values, on an individual capital city basis, home values have increased in all capitals over the past year. It is important to note that although values are still rising, they have slowed from a peak 12-month rate of growth of 11.5% in April, and the 8.5% growth over the past 12 months represents the slowest annual rate of growth in a year. This moderation in the annual rate of growth has been experienced across all capital cities except for Hobart. Along with the slowing in value growth, the number of dwelling sales is also trending slightly lower. Over the September quarter, there were approximately 119,000 house and unit sales nationally, which is 1.2% lower than over the same period a year ago. The rate of growth in the housing finance commitments has also begun to slow, particularly the number of owner-occupier commitments. The slowdown in mortgage demand is a key leading indicator of home sales. The slowdown in buyer demand has been accompanied by a recent drop in auction clearance rates. In September, clearance rates across the capital cities were typically recorded around the low 70% mark. More recently, clearance rates have fallen to the mid-60% mark. This trend has also been evident in both Sydney and Melbourne. While auction clearance rates have eased, private treaty measures improved in October. The average number of days it takes to sell a home fell from 41 days in September to 36 days in October, which was a historic low. Sydney and Melbourne have the fastest selling times at 27 days and 34 days respectively. Vendor discounting rates remained at 5.5% over the month, which is well below the long-term average. Given we have now reached the end of the spring season, it's interesting to note just how much newly advertised listings have ramped up. Across the capital cities, the number of new listings is 0.4% higher than a year ago. The total number of listings is 2.4% lower than a year ago, highlighting the relatively fast rate of sale. It is worth noting that over recent weeks, total listings have mounted, indicating that more recently the pace of sale may have eased. Adelaide home values fell in November and were 0.5% lower over the 3 months to November. Home values are still higher over the past year, but have only increased by a moderate 2.8%. Although value growth has been limited, sales activity is increasing, up 4.5% year on year. The average vendor discounting and time on market have also reduced over the past year. Sydney continues to be the primary driver of overall home value growth, followed by Melbourne and Brisbane. The rate of home value growth has weakened noticeably over recent months in a number of cities. Although all cities except for Hobart appear to have moved beyond the peak of their growth cycles, there remain significant variances amongst individual cities. Sydney remains strong, Melbourne appears to be slowing, Brisbane is holding up reasonably well, Hobart's market is picking up, while the remaining cities are seeing overall market conditions slow. The latest interest rate decision from the Reserve Bank, which saw rates remain on hold for the 16th consecutive month, makes it clear that interest rates are likely to remain stable for the foreseeable future, which will continue to keep a floor under housing demand. The growth in mortgage demand continues to moderate, particularly from the owner-occupier segment, while investor demand continues to ramp up. Based on housing finance commitments data, investors now comprise 50.3% of the new mortgage market. In New South Wales, the proportion is substantially higher at 59.2%, while investors account for 53.9% of the Northern Territory's new home loans and 50.9% of Victoria's new loan commitments. Investors may already be feeling a little bit uncomfortable with the heat in the market and the recent RBA warnings. Although investment activity continues to rise, up a further 3.7% in September, the rate of increase in the value of investor mortgage commitments has slowed from a recent peak of 40% annually in December last year to approximately 25% in September. If APRA introduces macroprudential measures to cool investor demand, as is widely expected before the end of the year, we are likely to see investor demand slow further as the cost of debt rises in response to the regulatory changes. In the meantime, we actually may see a lift in investor mortgage demand as some investors look to beat the potential changes. Thank you very much for tuning in to CoreLogic RP Data's housing market updates all this year. We hope you and your family have a great Christmas and New Year, and we look forward to working with you again in 2015. You can find out more housing market information at our website and research blog located at www.corelogic.com.au.